In the prior video, we went over the similarities between an iron condor and an iron butterfly. Both trades combine a credit call spread with a credit put spread to create a range or zone of profitability. Now let's look more closely at examples of both, how they differ, and how we might use them. As an example, we open an iron condor by selling a $1 wide out-of-the-money credit call spread at 25 cents, which on its own would be risking 75 cents. But we simultaneously sell a $1 wide out-of-the-money credit put spread at 25 cents. In real-life conditions, the two prices might differ, but the net credit is the important figure here. Combined, we receive a net 50-cent credit from selling the two spreads. Since the width of each spread is $1, the net risk of the trade is the risk of one side of the spread minus the net credit received from both spreads. Why is that? If this trade is max loss at expiry, it can only be because one of the spreads is completely in the money. The other would be out of the money and worthless. The stock can't be in two places at once on expiration. Therefore, the risk of this spread is 50 cents, not $1.50. A note, if the two spreads are different widths, the net risk is calculated based upon the wider of the two spreads. Once again, if the stock finishes between both spreads expire worthless for the max gain equal to the credit received. Now let's compare that to an iron butterfly, where we again simultaneously sell two credit spreads. But in this case, the spreads are wider at $3, and the short call and put are centered on the same strike. In this example, we collect a combined $2, selling each $3 wide spread for $1. Again, the risk of the trade is the width of one side minus the net credit received. So the risk on this trade is $1. That's $3 minus the combined $2 credit received. However, to realize max gain, we need the stock price to pin to our short strike level. Since the likelihood of this happening is relatively low, it's more likely that we find one side or the other in the money at expiration, with the other out of the money. So realizing max gain on an iron butterfly is difficult and often unrealistic. Because the iron butterfly has a precise max gain level, some traders place the trade with a slight directional skew, centering the trade at a price target slightly higher or lower than the current stock price. This is still a fairly neutral trade, but it gives some room for the stock to move towards the max gain level.
Trade on a new breed of brokerage. Trade smarter with Options AI.